Okay, should we get started? Okay. Good afternoon, everyone. We appreciate you joining us. As always, we have a full presentation today, so let's get started. You may notice that our team has a new addition. I would like to introduce you to Kelsey Fogel, our Client Service Administrator. Kelsey will be working diligently to improve your client service experience. Of course, we also have Milt Fullen, Kevin Fix, Justin Seidenwan, Paula Miller, and myself, Brianna Stein. As always, we have disclaimers. This presentation contains the most current information that we have available. However, we are in a very fast-moving environment. We verify all of our information and obtain it only from what we believe to be reliable sources. However, much of the information that we use is subject to revision. This presentation is not intended to be used for personal tax or investment advice. Our clients know that we provide such advice routinely. However, when we do, it is in the context of one's financial plan, and we have their financial details in front of us. I'd also like to note that Kevin and Milt have again received the 5-Star Wealth Management Award for 2021. You make this award possible with your continued support. For that, we are truly grateful. Here is an outline for today's presentation. We'd like to provide you with some information on advisorclient.com website capabilities. We will discuss some information regarding Dropbox in your quarterly reporting. We will provide a recap of the markets in 2021 and review some of the key market indicators. We will also conclude with some Q&A. We have allotted some time at the end of the presentation for Q&A. However, feel free to ask your questions using the chat feature at any time. Many participants have some questions, Paul, so we will answer those questions as well. With that, I'll pass it over to Justin to get us started.
Thank you, Brianna. As you all know, TD Ameritrade announced in November 2019 that they had agreed to be acquired by Charles Schwab. Our understanding based on communications from our TD service team is that April of 2023 is the targeted date of conversion. We should be able to automatically repaper all accounts, so you as a client shouldn't have to complete paperwork as part of the conversion to Schwab. This will create one of the largest custodians in the industry, rivaling Vanguard and Fidelity. We will keep you posted as more information becomes available. In the meantime, you can still access your TD Ameritrade accounts online via the website advisorclient.com. As we move into tax season, you may be wanting information from your TD Ameritrade accounts or tax statements such as 1099s. You can access all of this information on Advisor Client, which can be accessed both on a desktop computer or on a mobile browser. There's also an Advisor Client app that you can download on your Apple or Android device. Let me show you how you can access the website. So if you're on a computer, an easy way to get to advisorclient.com is by going to our website at fullenfinancial.com. And you should see in the top right-hand corner of the page a green button that says Clients. If you click that button, you'll be taken to another page, the client login page, which has a series of shortcuts for websites you may use as a client of ours. You should see a series of clickable links, which clients of ours may find helpful. So in addition to the link to Advisor Client, we also have links directly to Money Guide Pro, where you can access your financial plan. We also have a link to Dropbox to share files with us and more. So to access your TD accounts on Advisor Client, you want to click the green TD Ameritrade button in the top left corner. That should bring you to the advisorclient.com page. You'll be prompted to log in, or if you've never accessed the site before, to set up your profile. If you haven't logged in before, or if you can't remember your login info, reach out to myself or Brianna, and we will make sure you have the info you need to log in. For married clients, or for clients who want to have both spouses' accounts grouped under the same login, we can accommodate that as well. We just need to complete a form called the advisorclient.com access form to link all the accounts under one sign-in. So if you need any help with Advisor Client, just reach out to myself or Brianna and we'll make sure you're squared away. On the Advisor Client website or app, you can review account activity, you can generate and download tax forms such as 1099s, you can link bank accounts, initiate deposits and withdrawals, etc. You can also update your contact information. If you move to a new home, for example, TD will require you to update your address on your end, as we, the advisors, cannot change your address or contact info as a security precaution. This is another example where logging into Advisor Client is helpful, as it prevents you from needing to call TD Ameritrade to change or verify your address or change a phone number, etc. That being said, if you need to update information for your accounts and you have trouble, don't hesitate to reach out and we'll facilitate a solution to the best of our ability. We encourage our clients to use Advisor Client and to access their accounts online periodically. As a reminder, Fullen Financial Group does not custody assets. TD Ameritrade custodies the assets that we manage, and they are completely independent from Fullen Financial Group. All statements and tax forms are generated by TD Ameritrade from the information they have on the accounts on their platform. Fullen Financial Group has no input on this information. At any time, you can log into your TD Ameritrade accounts directly on Advisor Client to view your accounts or any activity. For those that prefer doing everything on your phone, you can download the mobile app. Just go into the App Store and search Advisor Client, and you should see the Advisor Client app. It's currently available and free to download on both the Apple Store and the Google Play Store for Android. One important note, ensure the app that you download says Advisor Client in the name. There are a few other TD Ameritrade apps available for other types of TD Ameritrade users, but all Fullen Financial Group clients are on the institutional TD Ameritrade platform, which is accessed via the TD Ameritrade Advisor Client app. So before we move on, Brianna should be prompting a poll question here. So the question is, which of the following actions can your advisor not take on your behalf? So we have initiate a monthly deposit into your TD Ameritrade IRA from a linked bank account, reset your Dropbox link, change your contact information on your TD Ameritrade account, such as a phone number or mailing address, or resetting your advisorclient.com password. So we'll give you a moment to respond here.
This is a test to see who is listening.
All right. So yes, the correct answer is to change your contact information on your TD Ameritrade accounts. So again, that's something that TD Ameritrade does kind of put the onus on the client. So again, if you have any questions or need help logging into Advisor Client, feel free to reach out to your associate advisor, myself or Brianna, and we're happy to assist you in accessing the website or troubleshooting any problems you might have. Now I will go ahead and turn it over to Kelsey.
Thank you, Justin. I wanted to spend a few minutes discussing 3 reports that are being uploaded into your shared Dropboxes each quarter and where they are located. But before we get started, I would like to mention a few things about Dropbox and say that if anybody needs assistance with Dropbox or uploading any forms or documents, to contact me directly. My email is on the screen and I would be happy to help. I will also mention that if there's anything you would like us to look over or that you would like to discuss with your advisor, to upload them to your transfers folder located in your shared files on Dropbox. The first report is the MoneyGuide Pro Net Worth and Asset Allocation reports. These are going to be located in your financial planning reports folder on Dropbox. This report gives you your net worth summary with a detailed report of accounts and what information is being used in order to calculate your net worth. This report also includes a resource summary, your invested assets by tax category, as well as a worksheet detailing asset allocation comparison. The second report is the Panoramics Performance Report. These are going to be located in your Performance Reports folder on Dropbox. This report gives a graph showing your portfolio value and performance history, which helps provide the big picture of your portfolio. The remainder of the report shows your account performance history, detailing portfolio returns and individual account returns. The third being your fee statements. This is not necessarily a quarterly report, but they are being uploaded to your Dropbox as each quarter, and these are located in your fee statements folder. These are the statements that show your accounts, your account value, fee, and fee being billed to each account. If anybody has any questions regarding any of these reports, you're welcome to email me and I would be happy to assist. And then before I pass it over to Milt, we have a quick poll question. So the poll question is, which folder in Dropbox should you upload any forms or documents that you would like to discuss or look over with your advisor? Your estate documents folder, transfers folder, tax reports, or Ameritrade forms and reports folder. Yes, so the transfers folder is the best folder to upload anything that you would like to look over or discuss with your advisor. And now Milt will be discussing.
Okay, thank you, Kelsey, Brianna, and Justin. What a year we've had. Before I start, I do want to acknowledge the three very important people who have just been speaking, as they represent the backbone of Fullen Financial strengthening client support capability. These associates, Justin and Brianna, and our new, relatively new client service administrator, Kelsey, they're getting better and better at delivering world-class service, and they're doing this in a very, very difficult environment as they continue to grow and become an integral part of our team. We also look forward to these individuals moving into more senior roles. Now, let me get started here and let's look at some 2021 investment highlights. Again, it was a very interesting period. GDP, which is made up of total goods and services sold in the US, was up for the year 5.7%. Q4 alone was up almost 7%. We have not seen this level of growth in decades. The S&P 500 ended the year at all-time highs. It set 70 records throughout 2021, driven by corporate earnings that were up over 2020 by nearly 50%. This is also a record. The historical average of annual earning increases is only about 5%. However, let me put some of this into context. These results were against a 2020 that saw company profits down substantially. Additionally, throughout 2021, the economy had support from an easy money policy that included ultra-low interest rates. It was also supported by a consumer balance sheet vastly improved during the early months of the pandemic with money from government stimulus. Estimates place this consumer balance sheet improvement at $2.5 trillion. Plainly speaking, many consumers stayed home and shopped online as never before. While many types of services, for example, airlines and hospitality, were down significantly, goods like cars and lumber ended up increasing at 7% over pre-pandemic levels. However, the goods increase came with a downside: the supply chain issues we're currently seeing. At the outset of the pandemic, many companies canceled their materials orders, believing demand for their goods were going to drop, only to find that their goods orders actually increased. The auto industry is probably the most notable. This combination of companies canceling materials to build their products while their orders actually went up alone would have stressed supply chains even without COVID. Now, add that many manufacturing facilities and logistics companies are operating with fewer workers or with stricter health protocols, and you can understand why our supply chains have become materially disrupted. We've never seen anything like this before. Many of you will recognize this slide as it identifies the major indices that we follow. The indices within the outline represent the basic asset classes in a diversified portfolio. The columns identify the results by asset sector for the full year 2020, 2021, and the fourth quarter of 2021. In reviewing this, let me point out a few of the salient figures. To say the least, 2021, 2020, and 2019 were very good investment years in the US, in spite of the headwinds. While US fixed income was down for the first time since 2013, the average annual US fixed income return for the last 20 years is about 4.5%. International bonds also lost money in 2021 after a strong 2020. The last of these indices we regularly follow, US home construction, US REIT investments, and AMX oil index, were all up significantly from 2020. There are a couple of points that I will return to in a few minutes, but let me at least identify them here. Relative to the US markets, international, both developed and emerging markets, have not performed well since 2008. However, if you look back at the 10 years prior to that, you would see that international equities were often found at the top of the equity performance tables. While picking inflection points is rife with mistiming, at some point international will come back. Another important point that cannot be seen in these results is the difference in performance between US value stocks and US growth stocks. But what this shows is that in 2021, like 2020 and 2019, risk asset classes performed quite well. Now I want to briefly identify what a hypothetical portfolio for 2021 produced in yield. This hypothetical portfolio I'm using consists of the 6 major indexes that make up a diversified portfolio. I'm also assuming that 35% is invested in fixed income and 65% is invested in equities, and that these investments were held for the full year. For 2021, this produced a portfolio return of 10.75%. This is consistent with our clients' 2021 returns, although individual returns will vary depending upon what the actual asset allocation was. Now I want to shift gears a bit and look at the price earnings ratio. Dividing a company's stock price by its earnings is one measure of how expensive a stock is relative to historical averages and to other stocks. The higher the PE ratio, the more expensive the stock. I show 2 types of PE ratios here. The first is known as the CAPE ratio, which uses earnings from the last 10 years. And the second is the forward PE ratio, which uses projected earnings for the upcoming 12 months. You can see that since 2018, the CAPE ratio has continued to increase. Contrast these recent CAPE ratios to the historical average of 17, and you can see just how high, based on history, company valuations are. Note the forward PE ratio for 2022 assumes an earnings growth of 9% over 2021. This compares to the 50% growth in 2021 and a 5% historical average. On this slide, I separated the PE ratios of growth stocks from value stocks for all companies in the Russell 1000. Let me define a couple of terms. The Russell 1000 represents the 1,000 largest listed companies in the US. Growth companies can most easily be defined as those in technology, research, etc. These companies generally pay lower dividends and reinvest sizable portions of their earnings into R&D to support future growth. Value companies can most easily be defined as retail stores, airlines, restaurants, hotels, and most product manufacturers. These companies usually pay higher dividends, but don't reinvest as much of their earnings in research and development. As a baseline, look at the row for 6/30/2019. This is before COVID had any noticeable impact on the US stock market. At this date, COVID started to impact US markets, even though after that date started to impact US markets, even though no cases in the US were confirmed until February of 2020. Now observe the changes in growth versus value as you go up this table. Growth PE ratios, already high by historical standards, shot up dramatically, while the value PE ratios in the aggregate barely moved from their pre-COVID levels. Think back to what I said a few minutes ago. The aggregate sale of goods in the US supported by technology like Amazon went up 7%, while aggregate services slid dramatically. While the CAPE ratio is over 2 times the historical average of 17, the value CAPE ratios are far closer to that historical average. So you can see that the increasing Russell 1000 PE ratios are almost entirely driven by growth, meaning technology companies. The forward PE ratios assume the growth company future profits are going to continue to be above those of value companies. Are investors correct? Or are valuations, and in particular technology valuations, simply too high? Over the last month or so, there has been a slight rotation from growth companies to value companies, but how long this goes on remains to be seen. However, it is also possible that growth valuations are not as far off as one may think. Let me highlight a couple of events that came to light during the pandemic. We know many value companies, particularly in the service sector, struggled during the pandemic, and many initially lost over half their value. Conversely, most technology companies saw their values skyrocket upwards after the pandemic started. In large measure, these technology companies provided the only way to keep the economy functioning. So this may support some of what we see in these valuations. However, let me give you 2 more specific examples. In Q4 2021, Tesla sold more cars than they ever had, while production in the rest of the automotive industry was down because they couldn't get enough computer chips. So how did Tesla do this? Well, they had IT engineers who were able to reconfigure the computer chips they had to substitute for what they were missing. No other car company had the technological capability to do that. As Pete Wade, a client who recently purchased a Tesla, put it, Tesla is not built and designed by auto geeks, but by computer geeks. An even better example of that technological prowess some of these growth companies have in technology is that they produced the Pfizer and the Moderna COVID vaccine, and the speed with which those vaccines became available based on any historical standard was astounding. Tesla, Pfizer, Moderna, and the companies they work with did something relative to their peers that no companies in the history of CAPE ratios of 17 could possibly have done. So, are the companies that have this technological capability worth so much more than those who don't? We'll see. However, what I do know is that the money that growth companies are currently pouring into R&D is beyond anything that traditional companies that drove the CAPE ratio of 17 ever attempted. So the pipeline of technological innovation could be very exciting and very disruptive for several years yet. And we will see if these high technology valuations relative to history and their value company peers are justified. Now let's look at the US price earnings ratio compared to other countries. While the US forward PE ratio can appear to show US firms as being overvalued relative to non-US valuations, this difference has existed for over a decade. Although, as I mentioned previously, for the 10 years prior to 2008, emerging markets and international developed economies were routinely found at the top of the annual stock market return. At some point, a shift to international is probable. Supporting this, venture capital funding in technology research is becoming much more widely dispersed globally than in the past. While Silicon Valley's dominating innovation presence will be very strong for years to come, they are no longer the only game in town. Lastly, I want to touch on inflation, which, as you can see from these headlines, has become front and center in the economic picture. Now, Brianna has set up a poll question. The question is, what has been the average inflation rate between 2010 and 2020, the year the pandemic first started? Circle one choice here. I'll give you a couple of minutes to respond. The responses are interesting, more or less across the board. The actual answer is 1.7%. And let me get into a little bit of detail on this now. On this chart, you can see inflation from 2010 through 2021 highlighted in green. For most of this time, the US was below its targeted 2% inflation. In December 2021, inflation topped out at 7%, resulting in an average inflation for 2021 of 4.7%. This is compared to an average in 2020 of 1.2%. Highlighted in yellow, you can see that the inflation rate contracted rapidly right along with the economy after COVID was first found in the US. By May 2020, inflation fell to almost zero. Shortly after May 2020, large amounts of government support started to be released and the Federal Reserve reduced the federal funds rate to zero. The economy started growing again, although this also started the split between flourishing growth stocks and slumping value stocks. Not coincidentally, after May, you can see that inflation started to increase for the remainder of 2020 and continued through 2021, ending the year with inflation reaching levels not seen since early 1980. Until around October 2021, the Federal Reserve let inflation run up, believing it would be transitory. Unfortunately, inflation kept running up, forcing the Federal Reserve to change its approach, and it began to address inflation by acknowledging they will be increasing interest rates and stopping and eventually reversing their bond buying. So what is driving inflation? Goods demand is certainly exceeding goods supply in large measure because of three broad categories of bottlenecks. And by the way, all of these were in place before the pandemic ever started. First, we're seeing a significant shift towards technology use in many products, from vehicles that use far more computer chips than their predecessors, to artificial intelligence behind many new technologies, to 5G telephone networks that require greater and greater speeds to deliver ever more complicated applications. These take more highly trained employees, a greater number of and more complex computer chips, and more sustained commitment to R&D. Second, workforce participation is down. This is caused for several reasons, but significant contributors being baby boomers retiring earlier than they had planned and fewer immigrants in the workforce, both on long-term skilled workers and short-term visas. For example, those who staff restaurants, hotels, and perform seasonal farm work. Third, we're also seeing a shortage of housing. Building permits have gotten harder and harder to get over the years, and tradespeople are in short supply. I recently read an assessment from a building industry trade publication that identified that US home building is the same number of homes that we did in the 1960s, with a population that is 40% larger today. Rising interest rates is one tool available to us, and history tells us this will slow the economy and reduce inflation. But it will not fix the structural issues that we are dealing with that I identified above. Gridlock in Washington will prevent legislative solutions, so we are left with basically technology to try to solve these problems, which will hopefully continue to increase productivity and may also continue to support higher growth company valuations. This slide shows the stock market returns and inflation rates from 1928 to 2020. The blue line represents stock market returns. The red dots represent average inflation by year. Do you see a correlation? It's a little bit of a trick question. There isn't one. So let's look at this from another perspective. This table displays the 17 years since 1935 with the highest US inflation rates. It then compares these years to the performance of the S&P 500. Almost 1/3 of the time, the S&P 500 returns are negative. Almost 1/2 of the time, the returns are double digits. Just over 1/3 of the returns are up over 20%. The average return for the S&P 500 during these 17 highest inflationary years is 9.4%. Guess what? All these are consistent with the long-term averages of the S&P 500 for the last 90 plus years. So what is one thing this table shows us? Don't run from the stock market during times of inflation. If anything, is probably the only way that individuals and families even have a chance of staying ahead of inflation. Now let me turn this over to Kevin, who will provide a 2022 outlook.
Thanks, Milt, and good afternoon, everyone. We appreciate you spending some time with us today. As you can see from Milt's comments, the markets generally performed well in 2021, but we do face some uncertainty on several fronts heading into the new year. Over the next 15 minutes or so, I'll talk more about those issues as we review some key economic indicators and provide an outlook for 2022. Now, I've said in the past that no one has a crystal ball when it comes to the economy. And even if we did, at this point, it would be quite cloudy. In fact, I would contend there's more uncertainty in the economy and the markets as we sit here today than there was at this time last year when we were still in the midst of a global pandemic. So as I think through the state of the economy right now and try to conjure up a vision of where it might go from here, I'm reminded of a quote from the economist John Kenneth Galbraith, who said the following. He said, "The only function of economic forecasting is to make astrology look respectable." And yes, he was an economist. So for a bit of context, Galbraith was a brilliant economist. And as you can see, he was also a bit irreverent. He had a sardonic sense of humor, especially when it came to economics and politics. As a result, he was quoted quite frequently. And one of his other quotes, I think, is on a more serious note, also quite relevant for today. And that is, one of the greatest pieces of economic wisdom is to know what you do not know. As we look ahead in 2022, there's a lot we don't know. And you'll see a common theme emerge as I go through these charts. Not only do we have some challenging issues in front of us, but the range of outcomes on these issues is really quite broad. So those who try to predict what will happen with the economy or react to new developments in the market will not be practicing what Galbraith considers economic wisdom. To kick things off on the economic outlook, we've got one more quick poll question. We're going to do our own sort of consumer confidence survey here for the audience on the call. The question is, how do you feel about the state of the US economy right now? Positively, negatively, neutral, or unsure? And unlike the last three questions on this one, there is no right answer. So we'll give that just a moment. All right, and you can see here pretty evenly split across the board. So that's not too surprising given where we are right now. Thank you, Brianna. Now, before I dive into the various metrics, I want to spend just a couple more minutes looking at the big picture. Last year, we spoke about getting to a new normal as we recovered from a global pandemic. Today, that pandemic is still with us, and with it have come some fundamental changes in society, in the economy, and in the workplace. Millions of people have left large, densely populated urban areas for smaller cities and rural areas. And this has been facilitated by very liberal company policies regarding remote work, which many companies have started to signal will become permanent. At the same time, several million workers have left the labor market, at least temporarily, as COVID has disrupted health services and most other service industries. These departures, with chronic staff shortages due to illness and/or isolation requirements, have exacerbated the supply chain disruptions we've seen since the second half of 2020. And those disruptions, in the face of rising consumer demand for goods and services, combined with generous government support during the pandemic, have brought inflation levels we haven't seen in several decades, which the Fed has already started to address. In addition, the pandemic has brought significant changes in market dynamics that may be temporary, but also may have profound long-term implications for the economy and for investors. Those include a concentration of market power among fewer large firms, governments that are more willing to intervene and intervene in a big way in response to major economic events, and the staggering increase in national debts that we've seen as a result of these programs. Now, each of these issues on its own would be significant, but if you think about a society and an economy that's dealing with all of these challenges at once, you can see why the crystal ball is so cloudy right now. So with that backdrop, I now want to turn to the economic data for 2021 and an outlook for 2022. The first metric we have is GDP growth. And on this slide, we're showing the year-over-year growth for the past 3 years. Of course, it should come as no surprise that GDP grew in 2021 following the decline we saw in 2020. In a normal year, this kind of growth would be considered quite phenomenal relative to more steady state growth like we saw in 2019. On a quarterly basis, GDP growth was strong in the first 2 quarters at 6.3% and 6.7%. And then we saw a slowdown in Q3, pretty significant slowdown, with growth of just 2.3%, due primarily to reduced consumer spending with the emergence of the Omicron variant. But then in Q4, GDP rebounded strongly to an annualized growth rate of 6.9%, ending the year with some positive momentum. So where does GDP go in 2022? Current estimates say growth in the US will be around 4% for the full year. However, these estimates may not fully reflect recent interest rate projections from the Fed, which I'll talk about more in a few minutes. At the global level, GDP growth is also expected to moderate to about 4.4%, following growth of about 6% in 2021. So I think it's fair to say the economy certainly faces some headwinds in 2022, with ongoing supply chain challenges and the withdrawal of support from the US government. But a 4% growth rate would still be pretty robust by historical standards. Now let's take a look at inflation, which Milt has covered at some length already, so I won't go into it too deeply, but current expectations are that inflation will moderate somewhat in 2022 with all the work that's being done to address supply chain disruptions and with the elimination of government stimulus related to COVID. It's unlikely, however, that we'll see a return to pre-pandemic levels of inflation yet this year. Milt touched on some of the dislocation in the labor market that will likely continue to drive wage growth in the near term. And another wild card in the inflation picture is China, which has gone through some economic disruptions of its own in 2021. China continues to pursue a zero COVID policy, and its government has become more intrusive in its regulation of large businesses in many sectors of the economy. To the extent either of these continue to weigh on the global supply chain, we will not see inflation come down as quickly as we might hope. I want to spend a couple minutes looking a little more closely at the labor market and specifically at unemployment and labor market participation. As you can see here, despite the labor market disruption I just mentioned, unemployment is actually quite low and is approaching the so-called full employment level we saw in 2019. Yet, even with this low level of unemployment, unfilled jobs remain at historically high levels, which clearly demonstrates a mismatch between open positions and available workers. Much of this is due to the stubbornly low labor participation rate, which remains below what it was before the pandemic. And you all have probably heard people refer to the Great Resignation, and the data actually shows that this is a real phenomenon. Estimates are that about 3 million people who were nearing retirement decided to move that date forward as a result of the pandemic. And unlike others who have left the workforce for pandemic-related reasons, those folks are not likely to return. But that's really only part of the story. Many younger workers, particularly women, have left the workforce due to disruption in schooling or daycare, and Omicron has extended this challenge for many. Others have decided to leave customer-facing jobs and look for other kinds of work, or to relocate away from large cities where the jobs are more plentiful. In the short term, I think labor participation is likely to improve somewhat as COVID-related unemployment benefits expire and hopefully school and daycare situations eventually stabilize. Some of this dislocation, though, will take longer to resolve, as some workers will need to retool their skills to qualify for their preferred jobs. And these issues, combined with lower levels of immigration, as Milt also mentioned, will likely weigh on economic growth for some time to come. So with that, I want to look now at how all of this is starting to impact government policy, starting with the federal funds rate. As we've discussed in the past, the Fed uses monetary policy primarily as a tool to maintain balance between the unemployment rate and the rate of inflation. And we're now in a classic scenario where the Fed would consider a tighter monetary policy. Unemployment is low and inflation is rising. As of today, the Fed funds rate remains at near 0%. However, that is expected to change very soon. Current expectations are that the Fed will begin to raise interest rates in March, and that we'll see 4 to 5 quarter-point increases by the end of 2022. This will bring the Fed funds rate to a range of 1.25% to 1.5% by year end, which is a significant amount of tightening. And this is one of the more significant areas of uncertainty going forward, as the Fed is largely in reaction mode at this point, as inflation has proven to be stronger and perhaps more resilient than originally thought. It's a bit early to talk about when the tightening cycle will end, but I think it's fair to say policymakers will be challenged to engineer that proverbial soft landing that reins in inflation without triggering a broader recession in the economy. Now, I want to make a couple of points about longer-term interest rates as well, which have rebounded somewhat from their levels at the end of 2020. First of all, although rates on the longer end of the curve have increased, they remain quite low by historical standards. In addition, the yield curve, which measures the difference between short-term rates and long-term rates, is currently flatter than it was in 2019. And that's a signal that the market expects long-term economic growth to be more modest. Importantly as well, lower longer-term rates also signal that inflation is likely to moderate over time. The flatter yield curve does increase the degree of difficulty for the Fed when they raise interest rates, as increasing those rates too quickly or by too much could result in an inversion of that yield curve, where short-term rates are higher than long-term rates, which historically has been a leading indicator of economic recession. So the Fed might not have as much latitude with monetary policy as they would like. The second thing I wanted to highlight is mortgage rates, which are an important component of long-term rates. And they have started to move up a little more meaningfully in the last couple of months. It's possible that increased costs of borrowing will have a cooling effect on the housing market. Although, as Milt mentioned earlier, there's still some systemic factors related to zoning and construction costs that may keep home prices high for the time being. I spoke last year about another important impact of low interest rates, and that's the government's continued willingness to borrow enormous sums of money. Unfortunately, in a rising interest rate environment, this amount of borrowing becomes much more burdensome, and interest payments on the national debt will start to crowd out other spending programs or will simply add to the deficit. As you can see on this chart, national debt as of the end of the year was a record $29.6 trillion, an increase of almost $3 trillion from the prior year. And debt levels are up almost $7 trillion since 2019. Of course, the national debt has been growing steadily for decades, largely driven by demographics, but the continued expansion of the federal government, combined with tax cuts and massive stimulus programs during the pandemic, have put government spending on an unsustainable path. And when you consider that government entitlement programs like Medicare, Medicaid, and unemployment benefits consume about 2/3 of the overall spending budget, and defense spending is close to half of the remaining discretionary expenditures, it's really hard to see where large cuts in spending are likely to occur. Unfortunately, the most realistic way to address this debt is to raise taxes, which is not good news for our financial plans or our portfolios, but seems almost inevitable given the current situation. So on that note, I want to just touch briefly on the Washington agenda, which is really where fiscal policy like taxes and spending come into play. In general, we see fiscal stimulus starting to wane for now, as most of the pandemic-related support programs come to an end, both for individuals and businesses. One potential piece of additional stimulus, the so-called Build Back Better legislation, is currently stalled in Congress and seems likely to be pared down somewhat from earlier versions, if anything is passed at all. Tax increases have also gotten some airtime in this administration, although more in the context of paying for new spending programs than for any kind of meaningful debt reduction. I think the most we can say about tax proposals right now is that they're subject to change, and we'll continue to monitor developments on that front. Regulatory oversight also appears to be on the rise, emphasizing issues like consumer protection, antitrust, climate change, and occupational safety. And all of this is taking place in a closely divided Congress, where party takes precedence. We have a vacancy on the Supreme Court, and midterm elections are coming up in November. So the window for meaningful legislation in 2022 is likely to be short and potentially chaotic. So how are all of these issues reflected in current readings of consumer and investor confidence? As you can see from this chart, consumer confidence is up significantly from 2020, but still somewhat below where it was at the end of 2019. And you may recall that this index is based on surveys of consumers that asks them a couple of different things. It asks them to express confidence in the current situation, as well as expectations for the future. And interestingly, unlike the past 2 years, the biggest positive driver right now in consumer confidence is their view of their current situation, while their expectations for the future have decreased significantly. And this trend actually continued in the month of January, which ended lower than December with an overall result of 113.8, largely driven by a decline in future expectations. Consumer sentiment can be a fickle thing, driven largely by emotions and other psychological factors. And with consumer spending representing 70% of GDP, This is something to pay close attention to as we move through 2022. And with respect to investor confidence, the reading from December is a bit sobering as well. If you recall from last year, this metric is not based on subjective surveys, but is derived from actual trading patterns among institutional investors. The more of their portfolios these investors allocate to risky securities, the higher this confidence metric will go. Keep in mind that investors value equities not based on what's happening right now, but on what they expect will happen in the future. So this indicates that investors are becoming much more cautious about equities and how they might perform going forward. So let me try to tie all of this together and relate it back to your plans and your investment portfolios. As I look at this list of issues for 2022, what strikes me is that each of these has a pretty broad range of possible outcomes. Add to this list the recent geopolitical developments in Eastern Europe, and you can see why the markets have been jittery to this point in 2022. It's important to remember that markets crave stability, and stock values are based on future expectations. When actual events differ from those expectations, that causes volatility in the markets. And with such a broad range of possible outcomes, there's a higher likelihood that actual events will differ from market expectations. So the year ahead is likely to see continued market volatility as these questions are answered and new questions continue to arise. And let me just give you some final thoughts for today's presentation, then we can go to the Q&A. There will be temptations to react to short-term market movements, and we're going to do our best to prevent you from doing that. We have developed an allocation strategy for each of you that fits your particular financial circumstances, your goals, and your time horizon, as reflected in your financial plan. Your portfolios are designed to withstand short-term market downturns because we have a good idea of when you're going to need that money, and we've allocated your assets accordingly. As your plan results assume a certain rate of return for your assets, and that assumption is tied directly to your allocation strategy. If we start to change that strategy in response to short-term market movements or our expectations for those movements, the rate of return assumption in your plan becomes less reliable. So although we don't advocate reacting to short-term market movements, one important part of our job is to filter through these events and determine how they might impact key assumptions in your financial plans, including rate of return assumptions for your investments, as well as the various tax strategies we've developed. As we identify and monitor these issues, we'll discuss them with you as part of our annual plan review process and make changes to your plans if necessary. So in this type of environment, keeping a level head and sticking with the financial plan will continue to serve you well. If any of you want to discuss the issues here in more detail in the context of your own plan, feel free to contact us by phone or by email. So that concludes our prepared remarks. And at this time, I'll turn it back over to Brianna to take us through the Q&A. Brianna?
Thank you, Kevin. We will now open the floor to questions. You can use the chat feature to ask those questions, which is located in the lower center region of your screen. We also did have some questions that were sent to us prior to this call, so I'll suggest that we begin by answering some of those questions. The first question was, will there be a recession in 2022? Milt, maybe you can answer this so that Kevin can catch his breath. And you're muted also.
Yeah, thanks for not letting me get too far without any sound. Anyway, this is an interesting question, and it's one that I'm frequently asked. And let me add some, and the real answer is I don't know, but let me add some context to that so that our listeners can see the numerous conflicting components in the economy and they can perhaps make an assessment themselves. So let me divide my answer into two types. One, let me identify let me talk about the conditions that could contribute to a recession, and then about the conditions that would argue against a recession. So start with those that would contribute to a recession. Okay, we have a Federal Reserve who's going to raise interest rates, and soon. Against this, for the month of January, we saw a very strong negative reaction in the markets. This volatility will likely continue, and this could very negatively impact consumer sentiment as well. One reason for the negative market reaction is because of the Federal Reserve history of being too late to raise interest rates and then reacting too strongly when they do, such that the economy is tipped into recession. Slowing the economy is a very delicate balancing act, and quite honestly, the Fed does not have a great track record. Another issue we are often forgetting is that we have 10,000 baby boomers retiring each day, and the pandemic has accelerated this. This issue was here before the pandemic started, and it's still with us. In fact, it will continue till about 28, when the last baby boomer group retires. This is a deflationary or a growth inhibiting phenomenon. Finally, COVID is still with us, and any new variant with the wrong characteristics could reintroduce substantial marketplace disruption. So I'll call those three items that would tend to point toward a recession in 2022. Now let me talk about a couple of items that could argue against a recession. We still have very healthy company profits, with companies seemingly able to pass their costs through to their customer, increasing costs through their customers. At this time, about 45% of the companies in the S&P have reported their earnings, and about 78% of them have so far exceeded expectations. Next, we have consumers with $2.5 trillion more in their bank account, or less debt than they had prior to the pandemic. One thing that people might find interesting is the government increased their debt about $3 trillion. Well, about $2.5 trillion of that showed up on consumer balance sheets, it would appear. Finally, we have everybody in the economy who wants a job, has a job. And the salaries, particularly among the lower paid hourly workers, are substantially higher than they had prior to the pandemic. So you put these last three characteristics together, it's very unusual to have a recession when those kinds of realities are in the marketplace. So which ones are gonna weigh heavier than the others? I don't know. Certainly if the Fed gets it wrong, that may trump everything else. So we'll see. We'll just have to let 2022 play out and see what happens.
Okay, thank you, Milt. Looks like this next question is directed at you as well. So you talked about value stocks being relatively poor performing versus technology or growth stocks. I would have thought that value stocks, many of which, like manufacturing, such as P&G, would be booming as the demand for hard goods has increased. Why aren't we seeing this?
That's a good question. Let's keep in mind that when I talk about value stocks underperforming growth stocks, I'm talking about the aggregate of all value companies, not individual companies. So within the value category, there are many companies that have performed well, even though many of these companies initially fell in the early stages of the pandemic. The type of value companies that have done well is kind of interesting. Companies that produce or distribute products that can be used by individuals or in small group family tend to have done well. For example, I'm not sure how many people tried to buy a bicycle or a canoe or a kayak or a car during this pandemic and have found supplies limited and costs substantially higher. These firms have done well using GM, which initially dropped about 50% from its pre-COVID highs. and has come off those lows by over 200%. While other value companies like airlines, hotels, restaurants fell by even more and have yet to fully recover. I'll take Southwest Airlines. Initially, their value dropped by almost 60%. Unfortunately, they're still over 20% down from pre-pandemic levels. Unfortunately, so when you aggregate all the value companies, they net out to a not so favorable financial position.
Okay, thank you. Another question that came in was, every time I look at the news, the issue of supply chain is raised. Even when I order online, there's often a note that due to supply chain issues, my order will be delayed. How are we going to overcome this? Kevin, maybe you could take this one.
Sure. Yeah, unfortunately, I think supply chain issues are likely to stay with us at least through 2022 and maybe even beyond. But keep in mind, some of the supply chain issues we have today, particularly with respect to new and used vehicles, are due to some business decisions that were made at the beginning of the pandemic. Milt touched on this a little bit earlier. Many rental car companies sold their fleets when travel restrictions were first imposed. And he also talked about the decision by some major auto manufacturers to cancel their chip orders. So now you have a situation where new car inventories are down significantly. Rental car companies are scrambling to rebuild their fleets, which in turn has caused a severe shortage of used cars. I think issues like these will eventually resolve themselves as the market sort of gets back to equilibrium, but they'll take some time. But really, most of the challenges right now with the supply chain is, hopefully we kind of gave you the message during the presentation, it's due to a shortage of labor more so than a shortage of materials. If you think about food, for example, the food industry produces more than enough on the farm level, but just doesn't have enough people to harvest the crops, to operate the food processing plants, or to transport the goods to market. And so as local retail stores have become impacted by these supply chain issues and a lack of workers, online retailers like Amazon have just been overwhelmed with orders, and they're struggling themselves to find enough workers to, to staff their fulfillment centers and their delivery vehicles. As I talked about a little bit, I think most of the labor dislocation at this point is a function of the pandemic. So I really don't see significant movement on worker shortages until pandemic-related restrictions are fully lifted, both in the workplace and in schools. But at a more fundamental level, the pandemic exposed some pretty significant flaws in the global supply chain that may impact prices and availability of goods for years to come. If you think about it, one of the largest chip manufacturers in the world is based in Taiwan, and much of the global supply chain runs through Southeast Asia. And both of these are under increasing economic and political pressure from China. So many companies in the West are reconsidering those strategic partnerships and looking for ways to mitigate these risks going forward. At the same time, as companies have scrambled to meet demand in a reopening economy, many have sought out new supplier relationships or looked to automation or other innovations to solve the problems. So it's going to take some time for the dust to settle on all of this. So even when the immediate issue of COVID is behind us, I think supply chains will continue to be part of the conversation, probably for some time to come.
Thanks, Kevin. This next question is a good one. Is 2022 a good time to buy a car, a home, or refinance a mortgage?
I'll go ahead and take that one. I think maybe I'll try to hit each of those in turn. With respect to buying a car, I think 2022, for some of the reasons I just mentioned, might not be the best year to do so. There's some unique circumstances in the vehicle market right now. And I think there's a fair chance that prices will start to come back down as more inventory comes on the market. However, if you have an older vehicle that's paid off and you're putting significant money into that vehicle for things like repairs and maintenance just to keep it operational, you might be better off buying now, even if it means you don't get, exactly the car you want. And if you plan to finance some portion of that purchase, definitely keep an eye on interest rates. We talked about interest rates are likely to go up probably relatively soon. So that's something to keep in mind. Buying a home is obviously a bigger question. And I think it depends a lot more on the dynamics of the local market. Most of the folks on this call are here in Central Ohio. We all know the Central Ohio market, like many other places, has seen a lot of appreciation in the last year and a half or so. So, prices are relatively high, but at the same time, we've also just seen a huge announcement from Intel saying that they're going to invest $20 billion in a manufacturing plant just outside of Columbus. So, now might actually be a good time to buy, despite the fact that prices are a little high, particularly with mortgage rates continuing to be relatively low. And then with respect to refinancing, I think it's still something worth considering if your current rate is above, say, 4% or so, and if you plan to stay in your home for a while. But keep in mind that refinancing does sort of restart the clock on your mortgage. And so if you stick with a 30-year mortgage, you want to consider shortening the term of that accordingly. And we've seen with some other clients that closing costs are somewhat higher right now than what we've seen historically, depending on the lender, of course. But as a rule of thumb, you want the monthly savings from that lower mortgage payment to pay off those closing costs within a couple of years. So, those, I guess, are some general thoughts on those. Obviously, if anybody has specific questions on any of these issues or would like, some help thinking through options, we'd be happy to look at the numbers with you and provide some guidance.
Thanks. This next question came through the chat box, and either of you might be able to take it. Could you talk us through what will likely happen in the housing market with such small housing starts, etc.? Milt, I think you're muted. Yep.
I keep forgetting to turn the volume on. Yeah, let me start and take a shot at that one. The news is probably not good. I mean, in some places there might be a little bit of relief if you're a cash buyer, as interest rates might go up. But without more housing starts, it's going to be very difficult. It's going to be very difficult to get prices to move in a downward way. And as I mentioned in the presentation, this is not a new problem. This has been developing basically for years and years. We're just through zoning issues, we just are not producing the number of houses that we need to. So I don't see any sort of legislative position. I'm not sure if you can legislate such things even that's going to relieve that. And unfortunately, housing has another characteristic in terms of it's not what in economics term we would call very elastic. I mean, it doesn't go up and down. It's a very illiquid assets. And in situations where price might fall, people have a tendency to simply not sell, waiting for the price to recover. So on that score, I just don't have good news relative to suddenly an influx of houses that might push prices down. I don't know, Kevin, if you have any other or sort of any different view on that or anything you might want to add.
No, I don't. I mean, I do think, in general, markets tend to seek equilibrium, and rental rates will have some impact on that as well, I think. But I think there are some systemic issues, one being the zoning, and as of right now, at least, the costs of building have come up pretty significantly as well. So that may put a damper on on starts going forward. So I agree. I think the picture is not particularly optimistic right now.
Okay, thank you both. Another question here. Does the United Nations Climate Change Conference impact the economic outlook?
You want me to take a first stab at that one?
Sure.
Okay. I don't think so at this point. And one of the reasons I don't think so is while the climate change conference, I think, highlighted a number of issues relative to actions that should be taken. I think the commitments that have been made at this point in time aren't really backed up by what would translate into substantive actions that would actually impact the economy. Now it could, but by some estimates, climate change and what is needed to fight climate change would be quite expensive. And at this point in time, some of the commitments around that, I don't know that will happen. Now, what's interesting, if those expenditures did actually occur, they could create growth in some respects because these are new initiatives. So, I mean, the potential to have a significant effect on the economic outlook is there, but I don't think that as the action steps are spelled out, I don't think they're going to have too much of an impact. Certainly not in the short term.
I guess I would just add to that I think there is an undercurrent of sort of climate related maybe initiatives within the markets right now that are sort of outside of, things like these conferences or what governments might do, where I think that there is some momentum, certainly in the financial markets, to look at, opportunities to invest in greener type of industries, or maybe move investment away from some that are considered to be more harmful to the climate. And so, as that picks up, we'll have to see how that develops from an economic standpoint.
Another question here. Inflation is up globally. How would this impact and or delay the U.S. response to lowering its rates? I can read. Should I read the question again? Inflation is up globally. How would this impact and or delay the U.S. response to lowering its rates?
I don't think it will have any effect. I think the Fed has taken the position before that their focus is U.S. based, and that's what they're going to do. Now they might. I don't think how other countries look at their individual inflation situation and what they do from a central bank perspective is going to have much impact on what the U.S. does. Now the U.S. may react in a piecemeal way if it's seen that their policy steps are too negatively impacting another country, but by and large, I don't think they will. I don't think it'll have much effect at all. In fact, we saw some of this when we saw the taper tantrum of, I don't know, a year or so ago. That the U.S. and then how it affected some of the foreign markets, particularly emerging markets. I just don't think it will affect the U.S. very much.
I agree with that in terms of, government policy. What's interesting about inflation is it does tend to be one of these sort of metrics that can drive some emotional reactions among investors. And so seeing consistently high inflation rates in other parts of the world, in addition to the US, I could see could have an impact on investor mentality to some extent. But from a policy standpoint, I agree with Milt.
Okay, another inflationary question here. As a guard against inflation and unstable equity markets, what are your thoughts about some predefined percentages moving to gold and or silver?
I will start. How inflation turns out relative to the longer term, we still don't know. And if we look at inflation in the context of the long-term outlook for rates, we're not seeing a sizable increase. In fact, we're not seeing any increase at all, really, in long-term interest rates, such that the bond market would tell you, and the slope of the yield curve would tell you, at some point in time, inside of 10 years, we're going to be right back to where we were between 2010 and 2020 from an inflation rate perspective. Where we're dealing with more deflationary issues than we are with inflationary issues. So, let's say we have high inflation, or we can't get back to the 2% target for another year and a half. Okay, the question is, how long do you want to hold gold or silver when they may be moving down versus inflation might push them up? You've got to hit that. You've got to hit that inflection point just right to make any money on it, or to have it not turn into a negative investment. Now, if we were looking at a yield curve that was getting wider and wider, which would indicate that we might be expecting a sizable amount of inflation over the next 5 or 10 years. Even then, I don't think I would be a big favor of gold because, or precious metals in any way. And the reason is because in order to get any sort of a return, a meaningful return for most people's portfolios, you have to invest sizable amounts of money in those kinds of investments, which have a history of going for years and years and years of doing nothing. From an appreciation or depreciation perspective. So you could have an asset that, if you don't time it just right, is basically doing very little for a long period of time, which is not going to support very many people's, which is going to do damage to most people's portfolios. So I'm just not a fan of it. And I think I've talked many times, I think we all have, timing markets is just next to impossible. And having an asset that does not perform very well most of the time and trying to time the entry and exit points is just problematic.
Okay, I think that's all of the questions that have come in. We might just give everyone a minute or two to see if any questions come trailing in. Otherwise, I think that's all that we have for you today.
Okay, I want to thank everybody for participating. We greatly appreciate your support and participation in events like this. So, again, thank you very, very much.
Thanks, everyone.
Thanks for your time.
Thanks. We will see everyone for their annual reviews.
Thank you.
Thanks.
Thank you.
Take care. Bye-bye.